a total of $700 million in the next 2 to 3 years. And that is to recapitalize the bank and also provide us with funds to finance our expansion, both in terms of our network and the businesses that we're doing. We are somewhere around 15% capital adequacy ratio today, which is the required minimum capital adequacy ratio. We are looking at moving that up to somewhere around the 20s. IFC is the first tranche of those funds we're raising. We believe that we will raise $500 million before the end of the year. Before IFC, we had raised $100 million, and that is straight Tier 2 capital without convertibility. And now the $70 million from IFC is so important to us because beyond the Tier 2 requirement, there's also some confidence that IFC is investing in Diamond Bank.
Right, so maybe you can speak to the confidence and can share with us some of the details of the transaction. What I'm hearing is that $70 million, 7 years subordinated loan, and it's also convertible. But can you just give us a little more color on the interest rate that you're paying?
Well, I think you got it right. $70 million for 7 years. It's subordinated, convertible somewhere along the line, of course, at the discretion of IFC. Interest rate is very reasonable, and because IFC is a development finance institution, they are normally not commercially minded in terms of their investments. So the interest rate is very reasonable. I may not be at liberty to give you the full details of the interest rate, but I can assure you that they are very reasonable, and they are helping us in benchmarking what we are going to be doing in the commercial market. We already have briefed 2 bookmakers for the rest of the funds, and hopefully before the end of the year we'll be able to get the rest up to $500 million, and by next year another $200 million or $250 million to get to the required $750 million in Tier 2.
All right, so given the fact that it's dollar denominated, can you speak to the exchange risk that you're taking?
Yeah, it's a good question. The exchange rate risk has already been factored in, and what we do is to ensure that we do not have currency mismatch. We have quite a lot of transactions that are dollar denominated, and we push our dollars to dollar denominated transactions. We will not lend dollars against naira denominated instruments or assets. So by virtue of that, we have already mitigated the exchange risk. But even if we have to do that exceptionally, we also hedge. And it costs you a little money, but it guarantees that if anything happens in future, because this is a long-term debt for 7 years, that you will not be in a situation where you cannot raise the dollar to refund if you have to pay back.
All right, the final point for me is to speak to the retail banking strategy of the bank. Clearly, Diamond Bank is known very well as a SME-focused bank. Speak to the challenges that you're facing right now, and given the landscape, the changes we're seeing there with respect to monetary policy tightening.
Thank you. I had been speaking about this in a while, so let me start with the monetary policy tightening and the monetary policy rate and the index rate. What has happened is that CBN has paid a lot of attention to the foreign exchange market, trying to maintain stability. You know, it's a thin balance between maintaining stability at the foreign exchange market and then reining in inflation. So, and what has happened is that central bank had, from I believe November last year, moved monetary policy rate from about 6% to where it is today at 12%, and central bank has remained at 12%. Now is a big challenge because it means that your risk-free rate is 12%. Now any loans you create below 12%, you're already taking a loss. Now there's also a 1% general provisioning that you have to make for any loan that you create, whether they are good or bad.